Hello everyone and welcome to my first free trading lesson. This is the beginning of my free mentorship, which includes 4 free lessons that will take you from zero to your first profitable trade. If you complete these 4 free lessons, I guarantee that you will be able to follow all my trading signals that I send in my Discord community. If you are not inside the group yet, you will find a link down below and you will be able to join. In these lessons, we start by covering the very basics of trading, such as market structure, how to use TradingView, risk management, etc. And we will end with a very powerful strategy that you can start using straight away and will help you make your first trade. The remaining part of the course, which you will see locked here on the side if you have not purchased the one-to-one mentorship, is much more advanced and includes things such as volumetric analysis, order flow, and many more advanced strategies, which I have personally used to become top 115 trader on Bybit and make hundreds of thousands in profit. The paid version will include every single thing I know and every single thing that I use in order to trade. And it will get you to a level where you will be able to look at any chart and do the same exact analysis that I would do and then take the trades on your own with confidence without having to wait for my signal. So you will be able to get to a level where you can operate fully on your own. Depending on the pack that you have purchased, you may also have one-to-one private sessions with me where we can do charting sessions together, or we may go over anything that you have not fully understood. You will also have access to all my TradingView templates, my Exo chart templates, which are all platforms that you can use to read order flow, which is something that I will cover in my advanced course. Anyways, enough talk about this. Let's get straight into the lesson, which is going to start with risk management, which is one of the most important things that a lot of people actually overlook when they start trading. So why is risk management so important? It's important because it avoids you from liquidating your whole wallet and wasting all your money. You do not want to start trading today with $1,000, $10,000, or $100,000 and then not have the right risk management in place, and tomorrow you will be left with no money. So it basically avoids you from losing all your money when a trade goes against the way that we wanted it to go. Because do keep in mind that trading is a game of probabilities and we are going to take losses. Everybody takes losses. I even take losses. There is not a single person who trades that does not take losses. We just need to make sure that when we do take these losses, we don't burn our whole wallet with a single trade. So now another version of me is going to explain to you how risk management works and how we can apply it. So I hope you enjoy. So in order to have the right risk management, we need to have simple rules before taking trades, such as risk per position, entry, invalidation, and target. So when you see this on a chart, this basically means the position you're going to take. So the trade that you're going to take. This signals the entry, this little white line. The stop loss would be the end of this red box. So what happens normally, this is your entry. Once entry is hit, anything that is in the green box means you're in profit. Anything that is within this red box means you are in a loss. Now, being a loss doesn't mean that you are stopped out of your trade. You get stopped out of your trade where your invalidation is, which is at the end of this red box. So once again, it's this. So in my Discord, when you see me posting things such as these, this basically means that I expect price to go lower, get into my entry, and reverse to the target. And that's a very simple explanation of how to read positions on charts. Now let's get into one of the most important parts, which is risk to reward. So you're going to read here that there is this risk to reward ratio. What does this mean? This means that for every dollar that you risk, so let's say that on this position we're risking $1, okay? You want to be making typically at least twice of what you're risking. It wouldn't make sense, for example, to make a trade. Let's say we want our target to be 120,000 and to put our stop loss at 112,000. Because as you can see here, we are risking all of this downside in order to possibly make this much. As you can see, there's clearly a difference. And in fact, our risk to reward is now 1 to 0.6, which means you're risking $1 to make 60 cents. That doesn't really make any sense. So typically what I aim for would be at least a 1 to 2, which means we're risking $1 to make 2. And this means that if we get into our position and we risk $1, if price goes down to our invalidation, we lose $1. However, if price goes to target, we make $2. So typically my trades are anywhere between 1 to 3 and can go up to 1 to 10, but we will cover this more later. But yeah, this is just a mental note to not be taking trades such as this. This is not what you want to be taking. Now, the most important next question is, how much of my wallet do I want to risk? And I personally always recommend to not risk more than 1% of your account. I know that for some of you, it can be a very, very small amount, especially if you're trading with $100 or $1,000, even $5,000, obviously. Risking 1% of your account does not seem to give you great results. But it is not about the number, it's about the returns in percentage that we can obtain. So typically, I would risk 1%, but I also would not exceed 5%. So let's say that we take 10 trades and we are very unlucky, and every single trade that we take, we lose money. So next 10 trades we lose. We're that bad at trading. We basically have 0% win rate. So what happens? Let's say your account is 20,000. This is your first account. Let's say we have account one with $20,000 and we are risking 2% per position. So first trade, we have 20,000. We take 2% of 20,000, which is risking $400, which means that if we get our entry here and we have a $20,000 account, that if the price goes down below our invalidation, at this point, we have just lost $400. This is what it means. So that means that after the first trade, we now have an account of 19,600. So now we risk 2% of what our remaining account is, which is 19,600, which is $392, and we lose again. And after losing 10 trades in a row, we remain with 16,675, which means that after 10 losing trades, by risking every time 2%, we have lost just about 16% of the account. Whereas on account two, where we still have $20,000, but we have taken 10% risk per position, which means that initially we risked $2,000 of these 20,000. After 10 trades, look at the difference. We have now an equity balance of 7,000, just below 8,000. And that would mean that we have actually lost 61% of the account. So you can see the big difference that it does to maintaining a lower risk. And by the way, this would be even lower if we risk 1%. So now you understand that if you risk too much per trade, that your account can be burned out very, very quickly. Now, going back to what I was explaining before about risk to reward and why it is important is because if we can keep something that is above 1 to 2, let's say we can do every single trade at 1 to 3, right? And we can achieve this with a 50% win rate, which is not crazy, and it's quite achievable. That means that 50% of the time we lose and 50% of the time we win. So 50% of the time we're going to lose 400. So let's give a very simple example. 50% of the time we lose 400 on our 20,000. That means first losing trade we lose. We have 19,600 because we have just lost 400, right? But now we risk our 2% again, but this time our trade goes through on a 1 to 3, which means that we make 3 times the 400 that we've risked. Now here, the risk is obviously a little bit less than 400, but basically with the 50% win rate, this time that we win, we basically hit a 3x on the 400 that we have risked, which means we just made 1,200. And our account is now at 20,800, which means that we are now up. And if you can maintain 50% win rate and a 1 to 3 risk to reward every time, in the long run, over 100 trades, you will obviously be in profit. So based on win rate and risk to reward, you can figure out when you can achieve profitability. You can even look this up on anything. Basically, with a 40% win rate, or let's actually even do a 30%. So with a 30% win rate, in order to be profitable, all you need is a 1 to 3. And I can guarantee you, you can go check yourself, that in my Discord, we hit 1 to 3s many, many times, if not even more. And you can go see that the win rate is much higher than 30%. But let's stay like very conservative and let's say that you achieve a 30% win rate. that just takes 1 to 3 risk to reward in order to be profitable. If you increase that to a 50%, you can literally take 1 to 2 as a risk to reward, which means you risk $1 and you can make 2 and still be profitable. So already if you can achieve these win rates would be great. And I can guarantee that with my account, you can get to these levels if you really work hard, because I achieve sometimes even an 80% win rate on certain months, maybe even 90%. But those obviously are not every single month, but it does happen. So getting a 30-40% win rate is very possible, and I can guarantee you that taking 1 to 2 and 1 to 3 risk to reward ratio trades is also very possible, considering also that we're doing swing trading. So if you look at some of my positions that I have done, I don't have them here now, but I have taken trades on Ethereum where I've risked $1,000 and I've made $15,000, which is a 1 to 15. So yeah, you can just go and study this on your own, but basically it tells you at what point you're profitable based on your win rate and based on the risk to reward that you take per trade. So I hope this part is clear. I don't want to spend too much time on it because it's very logical. So yeah, to summarize, you want to be risking 1% of your account optimally, and you do not want to exceed more than 5. If you're feeling really confident, if you know that you're very good at trading, you can go up to 5, but do not exceed that. So yeah, now all there is left to explain is how do you calculate based on the wallet that you have, because of course some of you may have $500, some of you may have 20,000, some of you may have 1 million. And obviously you need to adapt the trading size to your wallet. So how do we calculate that? Basically, all you need to do is use this simple formula, which I will write right here. And let me take off these grid lines of the chart because they're so annoying. The formula you will be using to figure out the size of your position is this. So you have size of your position equal to the dollar risk divided by the percentage of your stop loss. We are looking for the size of your position, the dollar risk we have. Let's assume that we are trading with $1,000 on our account. So we take, as I said, you want to be risking 1%, but let's assume that we've gone through the course, that you've become good. So let's assume that we risk 2% per every trade, right? So now we know that 2% of 1,000 is $20. That will be the dollar risk we want to take per position, which means that once we lose all of this, once this is lost, at the end of this box, we have lost our $20, which is 2% of our account. So we plug in $20 right here. And then in order to check the percentage of your stop loss, once you have decided your trade, it will tell you right here. You can see this is at 0.95%, which means that we will divide $20 by 0.95%. And so our position size will now be 20 divided by 0.95%, 2,105. So when you go in your trading app and you want to take a long trade on Bitcoin with this exact trade, obviously you will have to check for each trade that you take. When it tells you how much do you want to open of your position size, it will be 2,105. Maybe the next position we take will be something like this with a much wider stop loss, and we do the same thing. We go and check the 2.58%, which we will plug in the percentage stop loss. The dollar risk will be the same because we have that $1,000 account and 2% risk. So again, $20, and you will take your $20 divided by the percentage of your stop loss, which you can see right there, right? When we click on this, and then you will calculate. Now, of course, this is for longs, and then you have the same thing for a short position. This should be very logical. I don't think I need to explain. Long, short. So what else is important to mention? Always place a hard stop loss, which means that when you enter your trade, you need to have set in your app, your trading app, a stop loss, which is basically the price that once reached, you are out of the position. No questions asked. You have decided what your stop loss was before, you set it in your app, and you let that be the stop price. You don't start moving it down. This is not what you want to be doing. You don't start making it wider. Oh no, I'm going to get stopped out. Oh no. And then you end up basically doing this. So look how ridiculous this is. When you move your stop loss down, this is what it looks like. You maybe had a nice trade and you get scared, like, oh no, I'm losing $100. Let me move it more down. Now you're losing 200. Now you're losing 3, 4, 5 just to make, let's say, $100. So you do not want to be panicking and moving your stop loss. Just set your hard stop loss. Once you're advanced, you can trade without a stop loss and you trade with alerts and you check the reactions. This is way more advanced stuff. Most times I don't even do this, and I can guarantee you I've been trading more than you if you're trying to learn from me. So place your stop loss and do not move it. And then another important thing is, do not get greedy with your profits. A lot of people buy things, maybe they're up $1,000 right here after risking 300, for example. And at this point, perhaps due to certain technical analysis, there is a take profit that it should be taken. They get so greedy because they want their full take profit, or sometimes they even move their take profit up, and then they end up making $0 out of this, or even taking a loss because they were too greedy to ever take profit. So part of my advanced course will also include when to take profit, etc., when to move your stop losses up, and things like this, which makes sure that you do take profits during your position and you actually end up with profit and not with a loss. Okay, so now that I've explained the basics of trading, which is risk management, by the way, I think I will eventually also cover a little bit on psychology and not moving your stop loss and controlling your emotions, even though that really comes with experience. There's not much that I can say, but I will do a separate part on it, probably something very small. But now I would move on to setting up your TradingView, which is the most important platform that you want to be using when trading. If you're a trader, you need to be able to use TradingView to an expert level. And it's not that hard. So let's get into it. Of course, in later lessons, I will explain further, but now I will give you the basics of what you need in order to track prices, etc. So all you need to do is go to TradingView, start the charts. It will tell you that you can start for free, sign up with the email, blah, 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 stuff like this. And then eventually get to a point where you can click on this little thing and out here and search right here, for example, Bitcoin. So very important thing. And I personally trade on Bybit and Blowfin, but I like to look at the Bybit chart. So what you want to look at is BTC USD.P, which means it's the perpetual contract, so the futures contract, on Bybit. So yeah, and then eventually I will explain that you can also look at other exchanges such as Binance and stuff like this, Coinbase especially. But for now, let's focus on BTC USD.P on Bybit. So that's the one you select. And once you get TradingView, probably you will have a very bright screen like this. I would suggest that you switch it to a dark theme because you do not want to kill your eyes. If you've seen my charts before, you know that I typically trade with different color candles, which you can change by clicking on the body of a candle, and you can choose your colors. I personally trade with white and gray candles because I don't really care about the colors. And when you become more advanced, you will also understand why. It helps with emotions. You really just look at the graph itself and not the green and start thinking, oh my God, we're going up, or we see red and you start freaking out. It kind of helps with that, but for now, this is fine for learning. So first of all, you can right click on the background, go to settings and go to canvas. And I personally like to remove grid lines. So you can go grid lines and put none. For the rest, as I mentioned, you can change the colors of the candles if you wish, body, borders, and wick. But for the rest, I believe everything is fine so far. Now we have a very clean and easy chart. So on the right here, you will see your watch list. You can delete everything if you wish. And I personally just keep things such as Bitcoin, etc. So you can go here, you can do BTC USD.P, add it, and now you have it always by hand, BTC USD on Bybit. Same thing you can do for Ethereum, Ethereum USD.P on Bybit, and as you add, you will see them here on your right so that you can switch between graphs whenever you wish. You can add sections. This is section 1. You can add another section if you want to do stocks, for example. You rename it, call it stocks. Here you can add whatever you want. Let's say you want to follow Apple. You can search up Apple on the NASDAQ, and now you have your stocks here. Typically, as soon as you sign up, you should get your indicators. I think it gives you volume, if I'm not wrong. Yeah, so this is typically what it looks like. For now, I don't think you really need it, but disclaimer, I do not use any indicators. Indicators are lagging. It's just information that is acquired, and it is old information, so nothing new. And people that use indicators, in my opinion, are mostly losing money. Because as I said, you're looking at old data that everybody sees. So for me, there's no indicators. You can look at volume for other things. But yeah, I don't use any. Sometimes you can use SMA and stuff like this. I will cover that eventually very, very quickly. But on my graphs, there will be 0 indicators. No RSI, no OBV, none of that bullshit. I only look at price action and I zoom in into candles on order flow. And I use certain tools that I will cover eventually, such as patterns, such as Fibonacci retracements, Anchor VWAP, fixed range profile, and things like this. So you will never see indicators on my chart. It also helps you keep your stuff clean. Here on the top left, you have your time frames. You want to select the most important ones. I personally use 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hours, 1 day, 1 week, 1 month. And now you have all the things that you need up here that you can switch between. I would also add 1 minute, 3 minutes. And yeah, so this will help you switch through the time frames very quickly. Okay. Then here you can switch between candles, line graph. You can switch between, that's pretty much it. You don't need anything else for your level. I will also cover candles for the very, very people that are at the beginning. I think most people don't need it, but I will quickly cover that in a second. But for now, I just want to tell you that you should learn how to use the object tree right here, this layers basically, because here is where you want to organize your technical analysis. So when I will teach you how to do certain things, such as horizontal levels, also you can add all these tools, you can favor them, and the ones that you use the most, you will see, for example, here on the right. So you can have quick access, right? So when I will teach you how to do horizontal levels, such as this daily level right here, you will see that when you place it with the horizontal array, it will appear here. Now, if you want to be really organized, what I suggest you do is change the name of this and call it daily level, okay? These are going to be higher time frame levels. And then what you can also do is create a template. So typically what I do, I assign different colors for my levels, typically this type of blue for my daily levels. I name them daily level, put this, the bottom is fine, to the right, same text, boom. And this is how I trace my levels. And so then you go template, you save as, and you do, for example, 1 daily. So then now, every time that you use the horizontal array, for example, let's add another daily level here, you can simply click on this thing right here, and you will see daily. And you can quickly place your level. I mean, you don't really need to rename all of these to like your daily levels, but one thing that you can do is create a folder up here, right? Where you can add your daily levels, and we can name these higher time frame levels so that you can quickly clear out your charts and always have a clean perspective whenever you want, and add them back like this. And then of course, now it doesn't really make a difference, but by the time that, for example, you also have your weekly levels, I'm not gonna rename this, but typically it would be like yellow like this, and this would be a weekly level. You can just hide them whenever you need. You also have other things to look at that you can like put on the graph quickly, take off, and get clarity. Now let me explain candles for the people that are really like beginners. What I was talking about before is that I don't need these colors because you can tell that a candle is up or down, not based on its color, but based on the open and the close. These are called Japanese candlesticks, and these are what we will use in order to trade. I don't care about what they look like. I'm not the type of trader to be like, oh, this is a doji candle and this is a hammer or whatever. I don't care. Just based on the high, the low, the open and the close, I can recognize them. I don't need to name them, and I know what they mean logically. So you don't need to learn all of that, but you just need to know the basics, which is that every candle is made up like this, right? This is the opening price right here. This is shit. All you need to know is that each candle is made like this, and it will have an open price. It will have a closing price, and it will have a high and a low. Okay, so every candle looks like this. As you can see, we can zoom in. Here we have our open, this is our close. These little wicks are the lowest point that this candle has reached in the 15-minute time frame, because as you can see, we have 15 minutes. Now, of course, each candle can change based on the time frame. For example, on the 4 hours, we have these candles, but it's all the same. It means that this candle, which makes up 4 hours of the day, opened right here, closed right here, reached the maximum of this price, and reached the minimum of this price. Okay? Of course, if the open is lower than the close, that means that the price closed higher, you get a green candle. And then if the open is higher than the close, that means that you obviously have a red candle. So that's pretty much it. This is all you need to know. We will mainly be using candles for strategies such as swing failure patterns, which is a simple movement below a wick of a candle where we go grab the liquidity, we close back above, and we target the other side of the range. But I will explain this further eventually for the basic course, and then I will do a more advanced course on SFPs and failed auctions, which are the two most strategies that we use with candlesticks. And for the advanced, it will obviously include way more information. It will also include order flow, which helps you like get it more right. But to make it very basic, we will be using candlesticks for these two setups. It's called SFP and failed auctions. Okay? And that is because candlesticks help us gain information on the weakness and the strength of the market, especially when we mix it with order flow. So as I said, you don't need to learn what this candle is called. We can see based on the wick that we have gone and grabbed liquidity below here. But then if you look at the close, you can see that there was buyers that brought the price back up and let this candle close above into a green one. So if we are to zoom on this candle, on the 1 minute, for example, you would see a lot of red candles going down, 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 and then you would see a lot of green candles going back up. And then when we sum it up into a 30-minute candle, you simply get an addition of all these. But in those 30 minutes, price has wicked down to the lowest level here, and then it was able to close right here at the highest level. So yeah, I hope it's clear. I hope it makes sense. It will make more sense as we go forward. So now I also want to talk about the expectations of the course of the one-to-one. So managing your expectations is a very important part of the process. Experience is necessary in order to fully understand the theory. Don't expect me to explain it and you listening to it once and then going on a chart and doing exactly what I'm doing. Perhaps it will happen with the basic stuff, such as tracing daily levels, weekly levels, and stuff like this. But do not expect to just watch one lesson or even the whole course and be able to trade as good as me or as good as a good trader. I will tell you very straight up, you're not going to become profitable when you finish the one-to-one because this requires practice and hours spent on the chart. When I learned to trade like this, it's not like I magically became profitable. I spent hours practicing the strategy, spent hours understanding the charts, analyzing the charts, and slowly with time, probably within 1.5 years, 2 years of charting and of getting experience in the market and risking my own money on different trades and recording statistics, that's when I slowly became profitable. Because just like with anything, mastery comes from experience. What I'm doing is giving you all the information that I have and basically a shortcut to something that works, that I know that works because I use it every day. And if you know me, you know what type of money I'm trading with, the kind of results I can achieve. I have been on the best Bybit leaderboards for some time. There have been days where I've made 6 figures. I constantly achieve pretty good results and I show them on my Discord. I make pretty crazy predictions live days before it happens, months before it happens. So, you know, this is for me at least, and for the people that have been following me for a while, a strategy that is proven to work, that if you master and spend some time on, you can achieve the same type of things that I can do. So I can teach you the theory, but all the parts on, you know, managing trades, having hesitation, having analysis paralysis, and all things like this, of course, that comes with experience. And that does make a big part of the trader that you are. So I can't teach you to not close your position when you get scared, but what I can teach you is how to get into the position yourself. And maybe some of you will be very, very good traders from the start. Maybe some of you will excel me within 1 week. But typically it takes time, it takes experience. So yeah, I don't want you to start thinking straight away, oh, I'm going out there, I'm gonna make 6 figures tomorrow. That's not gonna happen. And also what I don't want you to think is that once you learn how to trade, like I do with my strategy and all of these things, is that now you will not be taking losses, you will only have like profitable months. And once again, that's not the case. You will still have losses, it's part of the game. I still take losses to these days. I obviously take more wins than losses, which is what keeps me profitable. So even when you master it, trading will come with losses. As I've said before, it is a game of probabilities. So we can put ourselves on the more probable side, but even when you're on the most probable side, there is still that chance that you will take a loss. And I can guarantee you that will happen. What it is important is that you take each loss as a lesson, as a learning point. You journal your trade, you go and check it, you go see what went wrong. And that's what eventually builds up your experience in order to become even better. But what I can guarantee is that I will give you every single thing that I know. And if you go through my whole course, I can get you to a point where you will be able to look at a chart like I do and see the same exact setups that I see, and you will be able to have the confidence to take them without having to check for my signal, without having to wait for my analysis. You will be able to open the Bitcoin chart and see that there is a long opportunity at 100,000, there's a short opportunity at 140,000, or whatever it is. This is the point where you will be able to get. However, of course, I suggest that for the first year, 2 years, you keep following what I do, which will be free, and you see me as some sort of teacher and some sort of base to get inspiration from. Because of course I have more experience, I know what I'm doing, and if you keep looking, for example, on my videos on YouTube or the private live streams that I will do for the people that purchase the one-of-one, the altcoin streams that I will do, and the Q&As, with time, you will get that experience even faster. And you will be able to replicate and think like I do and see the things that I see. Because a lot of it comes down, as I've said, to experience. I can see certain things that perhaps take time in the market and that I've seen 100 times in the market and you have not seen yet. So yeah, I hope everything is clear. And this was the first lesson. Very, very basic. Nothing that has to do with like actual trading. That will be the second free lesson where I will cover the market structure. So I hope you enjoyed and I will see you in the next one. Hello everybody and welcome to my second free trading lesson, which is part of a bigger series of my mentorship to teach you how to trade like me and be able to look at any chart and come up with the same trades that I see and that I come up with. So in the last lesson, we covered all the basics of trading that you need, such as risk management, how to use TradingView, candlesticks, and I think that's it. Today, we are going to be covering market structure, which is one of the most important things that you need to know. Market structure is in fact one of the most important foundations that you need for successful trading, as it helps you being on the right side of the market, and it is crucial to understand the context of an asset and build a bias, which will then help you to make your trades in the right direction. This is probably going to be a very quick lesson, as market structure is really not that complicated, but we can distinguish between three types of market structure. So one, we have a bullish market structure. Two, we have a bearish market structure. And three, we have a range, or we can also call it a consolidation. So a bullish market structure means that we are in an uptrend. A bearish market structure is when we are, of course, in a downtrend, which means we are going down. And when we have a range, it just means that we're going sideways. Keep in mind, this is very important, that markets trend only for 20 to 30% of the time. And which means that most times we are actually in a range or consolidation period. And that is why we need to learn about ranges and adapting to them, because that's what we're mainly going to be trading. And failing to acknowledge that markets are mostly ranging and not getting used to trading those ranges is the reason why most traders do not actually ever achieve profitability. So I hope it's not confusing. Last time we had charts with green and red candles. Now I have white for up and gray for down, as this is my actual trading panel that I use every single day. Also, I'm going to be using Bitcoin on Binance in order to show you and explain all this stuff. Keep in mind that I chart on Bybit, but just for educational purposes and showing you and explaining to you market structure, I will be using the Binance one. But for future reference, when you're trading, when you've learned in the future, use the Bybit one. So very basic theory about market structure. We have a bullish market structure when we put in higher highs and higher lows. So this is what a bullish market structure looks like. We have a high, a low, and then we have a higher high, a higher low, and then once again, higher high and higher low, right? Very basic. Basically, every single high needs to be broken once again in order to get our bullish market structure. And it is important that the last low, so here, this is not broken, right? So you always need higher lows, and you need the previous high to always be broken by a new higher high, okay? Very simple. For a downtrend, it is basically the same thing, where you have a high that is put in, right? So we put in a high, we put in a low, and then we have lower highs and lower lows. Lower highs, lower lows, lower highs, lower lows. So then once again, we have a high, we have a low, and we have a lower low. Very, very simple. You see? Lower high, lower low. And so what you have is that this low needs to be broken in order to get our lower low. And the high right here needs to not be taken by price action. So you always need for the highs to be lower than the previous one. This one needs to be lower than this one. This one needs to be lower than this one, right? And of course, we need to keep breaking the previous low. And then of course, we have ranges where there is no clear direction and you just have highs and lows, right? Here, there's clearly no direction other than just sideways, you see? So in this case, we have highs and we have lows. And high, high, low, low. So very, very self-explanatory. Now let's go look at some examples on the chart, on the actual candlesticks. So first of all, a little trick, what you can do in order to make this easier for yourself, you can use the line chart. This will help you understand trends. And as you can see here, we can identify already an uptrend, which is made up by this high right here. Then we have a low right here. And then look what happens here. We break the previous high, right? Right here. And now we have a higher high. Sorry about my handwriting. It's a bit complicated to write on TradingView. And then look at this low. This low did not break this low. It did not break this low, which means that it is a higher low. And then once again, we make higher highs. This high gets broken, higher high. And then here we have a higher low. I think it's very self-explanatory. And then once again, higher high. Now what happens here? Here, for the first time, we break this higher low. This is now invalidated, right? This cannot be labeled as a new higher low because it is actually a lower low. Structure just got broken here. And then look what happens next. The next high, we can just consider this. The next high is actually a lower high. So we were unable to break above this previous higher high based on this uptrend right here. And now we have shifted market structure. But when is it that it officially becomes a shift of market structure? It is not when we break the previous higher low, but it is actually when we break the low that we have put here. So just because we broke this previous higher low does not mean that we have yet shifted market structure. It is a confirmed market structure shift only once this low is broken. So at this point right here, that's when you've officially shifted market structure. Obviously, this is a first sign of weakness, breaking the higher low, but then you want to put in a lower high and the lower low. At this point, you have confirmed, you have changed market structure to bearish market structure. And in fact, you can see that we just could keep putting lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. And you see a trend continuation. When you get better, you can start seeing market structures directly from candles. For example, here, we can clearly identify that there is an uptrend, right? Very slow one, but it's an uptrend made of higher highs and higher lows. And then here we start a small downtrend. And yeah, this basically sums up the structures that you can identify on the graph. And then ranges are pretty obvious. Here, we clearly don't have a structure, we're going sideways, right? Here, yes, we break the low, but this is actually a failed auction as we got back into the range. And it is right here that we're actually going to make the most money. And that is because, as I will explain in my advanced course, we can start tracing volume ranges, and we can start trading these ranges based on volumes, where based on certain tools, we can take longs at the bottom of the range and trade it to the top of the range, then take shorts at the top of the range and take them to the bottom of the range, and so on and so forth. So identifying a range early can actually be very, very profitable. But I will talk about this in the future in my advanced course. But this is basically where we will apply the two strategies that I've mentioned in my first free lesson, which are the SFP and the failed auction, if you remember, which mainly happen in a range, and we aim for a better entry, for example here, right? And we aim for a better entry before the start of the move, such as this SFP right here, so that we can get very good trade with good risk to reward. And then once the range gets broken, because eventually ranges get broken, we can get the follow through on our trade. For example, if you took this exact trade, which by the way is a very valid trade that I would normally take, you know, you can get a 1-to-7 risk to reward ratio, for example, or even if you trade it to the bottom of the range, this would already be a 1-to-5, basically. Actually, it could actually be even smaller because your invalidation is above the high, and it would be, for example, a 1-to-10. And you know, you can take this 5 times and be wrong, and then on the 6th time, you would still be profitable because you have done a 1-to-10 trade. But anyways, I already covered this in the previous lesson. So let's focus on market structures. So it's not always clear, and it can be hard to identify the market structure because there's also internal market structures, right? So for example, if we see here, we clearly are in a downtrend, making lower highs and lower lows. But when you zoom in, right here, for example, we technically have an uptrend. But these are lower time frame uptrends. In this big downtrend, we have a couple of uptrends, we have ranges, but for swing trading, which is what I'm teaching you, the most important part is to focus on the higher time frame. So for example, the 4 hour, you can see this much better on the 4 hours, that we are in a clear downtrend. So don't get confused on the lower time frame, stick to the higher one for your swing trades. Of course, if you want to trade on the 5-minute, 15-minute, 30-minute time frame, you can do that and you can look at the smaller time frame market structures. But I would say to keep a bias and to keep an overview of where the market is going, I would say use the 4 hour as a very good guideline to identify the trend. So as you can see, on 4 hours here, we have a downtrend. We have here an uptrend, etc., etc. Here we are clearly ranging. And remember that the higher time frame is always the most powerful one, the one that commands over the lower time frames. You can even zoom out on the weekly time frame and you can see that on the weekly we have an uptrend. So clearly in this bull market, why would you want to be taking short trades? You should be mainly looking at long trades because you want to be with the trend. This is one of the simplest secrets to trading profitability. The trend is your friend. Why would I want to go against this market, which just on every dip keeps pushing? You know, you're clearly way better off taking a long trade on a dip, such as here, right? Targeting higher targets compared to taking a short, for example, here, right? Like, what is the point of taking a short? There's like barely any risk to reward. We're in an uptrend. We're going to be looking for longs. In the bear market, for example, back in 2021, in this downtrend, look at this weekly downtrend. Here is where we want to look for shorts. Then we had the accumulation. And then guess when the new bull market started? It actually started when we confirmed the market structure change right here. This was literally the kick to the new uptrend. And from this moment right here, you should have been mainly looking for long trades. Of course, I do this many times. I do hedge shorts, but this is way more advanced. This is to protect positions, and it is done at certain levels, and you can make money off of it, but 80% of your trades in this market should be longs. So I hope it's clear that you mainly want to be following the higher time frame trend. Let me give you one of the most recent examples that where I actually took a long and made quite a bit of money. So we were in this downtrend, right? By the way, I just want to mention that sometimes these downtrends get invalidated, but this was actually caused by news, right? So when there's like Jerome Powell speaking and stuff like this, you might get these pumps. But as you can see, it actually ended in a lower low. So, just because you have this massive pump from news doesn't mean that you just changed market structure. Remember that in order to confirm market structure shift, remember that you want to make a high, a higher low, and then you want to break the high again. Only in this case, we would have confirmed the market structure shift, which as you can see, never happened. So I hope that you remember this part. And by the way, if you want to make this even more simple, you can use trend lines to identify whether we are in an uptrend or a downtrend. This could probably help you. But look at this. So we had this uptrend, right, on the higher time frame. We're clearly making highs, lows, higher highs, higher lows, higher highs, higher lows, higher lows. Yes, on the lower time frame here, we were ranging and we were breaking a little bit of market structure. But if you zoom out, you can see that we're clearly in an uptrend. So what happened here at 107 is that people started shitting their pants because they were looking at this lower time frame downtrend. But what I knew, very simply, that we were actually in an uptrend on the higher time frame. So on a dip, why would I look to short right here, hoping for this to keep going down, when this whole time, every single time we pulled back, we always had a bounce, right? Even here, pull back, higher lows, bounce. Once again, higher highs, pull back, higher low, bounce. So you need to be able to recognize the higher time frame trend and have the balls at support. Now, I'm not going to explain why this was a very, very easy trade, actually, which I have predicted way ahead. I can actually show you. So as you can see, I was able to take the short off of a very simple setup, which is the failed auction, which once again will be covered in my advanced trading course. And then I had predicted a long trade at 107. You can clearly see right here. Once again, all of these technical analysis will be covered eventually. So I don't expect you to understand it now, but just keep in mind that there was huge support right here. And I knew that this was going to be a good opportunity for a long trade. It didn't mean, of course, that it would 100% play out, but this was a very good risk to reward with a high chance of playing out. So whilst most people were shitting their pants here and taking shorts, I was taking longs, looking for that higher low to be put in and for that bounce. And by the way, it's not even wrong technically to keep on shorting on this downfall. But in the moment where we put a low, a high, a higher low, and we make a new high, from this moment, any smart trader should stop shorting because we have just confirmed the market structure shift that I've explained to you. And as you can see from there, we had continuation up. So all the people that kept on shorting here, because they're like, oh, there's no way Bitcoin is going to die. We need to keep shorting and shorting. Like, you're actually stupid because you could be following this very simple logic of market structure and avoid taking all these losses. You know how many people probably kept on shorting here because they were like, oh, all-time high is in. I'm going to short this shit back to 100,000. It's like, no, what the fuck are you doing? We clearly had a market structure shift. There's no point in you keep shorting. Follow the trend. The trend is no longer down. The trend is now up. And they would have been better off waiting for a little dip on this higher low and loading up on the higher lows. So I hope it's very clear and I didn't bore you explaining this many times. But I think now it should be pretty clear why market structure is so important. So even now, without any strategies, you could probably come up with something and with this basic understanding to actually make some profitable trades. Obviously, I'm not saying go now and do like trades off of market structure. Don't do that. But now you already start to understand how the market works. Like, you should have a clearer picture. Also, market structure is very important for what I will cover in the future for entry triggers. For example, we can use market structure in order to know when to enter a short trade. So for example, if we get to a support level, such as what I explained before, my long trade at 107, Here there's actually a very easy entry, which I'm not going to reveal, but if you have listened, you should know by now. So I hope you can identify it on your own. I will give you a little hint. It happened in this area. If you can identify it and you know what it is, you clearly have listened and you are doing great progress. But anyways, I'm not going to use that, but we can use market structure for our entry triggers. So let's say that this was the support that we had identified. One of the simplest ways to decide whether to get into a trade rather than doing it randomly is to wait for a market structure shift. So up to this point, we get to our support level, right? There's no point trying to catch the knife when you can just wait for the market structure shift right here. This is on the 4 hours, but we can actually zoom in and we can do this on the lower time frame. Let's say on the 30 minutes. In order to increase the probability of your trade playing out, you can wait for a lower time frame shift in market structure, such as on the 30 minutes. Because for example, there's no point entering here because we're just going sideways. But in the moment, if you want to be more secure, right, in the moment right here, where we have put the low, we then put the high, we then have the first sign of strength right here. So once we reach our support level, which I had identified between 108 and 107, right? Instead of taking a random trade and trying to catch the knife, what we can do is zoom in onto the lower time frame and look for a market structure shift. So as you can see, we put in a low here. We break the previous high that was here. So that is our first sign of strength. So we put in a high. We then put in a higher low, which is another sign of strength. And now what we want to do is wait for the market shift confirmation, which I've explained in this whole lesson. So I hope you really listened, and I hope that you're understanding now what I'm talking about. And at this point, that's when we can say, okay, we have shifted market structure on the lower time frame. Perhaps now there is a higher possibility that my trade can play out and that we can get that continuation. So what you want to do now is wait for another higher low and get your entry right here. And guess what? This will also really help you with your trade management, because now we can target, for example, our higher targets. Let's say we want to go to 118. That was the target I had given. And now you even know where you're going to be wrong. So you're not trading randomly anymore. You have your target, you have your entry off of these higher lows, which you know they make sense. Now you're starting to understand, okay, I know why I'm entering this trade now. And you have the stop loss at this low after the market structure change. So at this point, you have a perfectly valid trade, which makes sense. And in order to find this entry, I will explain it in my advanced course, but you can use Fibonacci in order to get your entry, which I will explain again in the advanced course. And if we fast forward, as you can see, we do a little bit of ranging. So here we have not had our entry yet. Remember that we need to break this high. We still have a higher low right here. We still have non-broken structure. So this is still valid. Here we have our break, like I had said. Now, of course, our Fibonacci is a bit different. It is from this low to this high. And obviously this doesn't mean that 100% you're going to get your entry here, but basically you're supposed to try and get your entry on the pullback to find the next higher low. And let's see, I don't know if this will get filled. Okay, actually, as you can see perfectly, I didn't even know this, like genuinely I did this randomly. So imagine that you had done exactly this as I had explained, and you had placed exactly this trade, and look at that, you get your perfect entry with minimal risk. I mean, you even had like barely any drawdown. There was no point basically where your position was at a loss. And from here, you could have literally just been chill and following the uptrend to eventually a very, very profitable trade. So I hope this is clear. I will explain this even more and with other tricks, such as looking at the volume and stuff like this. For example, another way to identify if the market structure is valid. So another more advanced way that you can help yourself with market structures and identifying when it is valid is based on value. Value is going to be covered in my advanced course, so don't mind it now, but I'm just showing you like how advanced this can get. So this represents value, which is like where most volume was traded. And when you see this shifts in value, that's when you can start identifying the uptrend, and this will really help you because you typically want to be following value. And yeah, so this is a more advanced trick which increases your win rate by a lot. Like even here, you can see always value shifting up. And in a downtrend, you have value. I can even activate after hours. But yeah, you always have value like shifting down, 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 etc., etc. So yeah, this eventually will be covered in my advanced course, and I can guarantee you that this can really, really help becoming even better. Seems very complicated now, but it's really not. So market structure is a very important component to your trading strategy. I hope that I covered like the basic things. I hope now you have a clearer view on how to look at graphs and how to identify the market. I think this should be enough. Of course, we can use it even on lower time frames, etc., etc. If you're interested in that, first of all, you can probably find more stuff online for free. But for the deeper dive, once again, I know I repeated this many times, but that will be in my advanced course. Also, another thing that I wanted to mention is that for ranges, for example, such as this one, you can use, I'll give you the first tool. By the way, I will give you all the tools now. So what you want to have in your trading view tool list is horizontal array, long position, short position, anchor VWAP, Fibonacci retracement. You don't need this. So actually, no, fuck. Well guys, I don't really know how to add that back, to be honest. Well guys, class is over. Okay, we added it back. So yeah, I was saying, you don't really need this vertical line. Anchor VWAP, Fibonacci retracement. I use these rectangles just for support. Fixed range volume profile, this is super, super important. You need to master this, and I will do that eventually. Not for free. Price range, data range, price range, date range. You don't really need this, but I like to use it. Trend line, brush, I use this for explaining. Trend-based Fibonacci extension, this is very important. Parallel channel. And yeah, that's pretty much it. And yeah, what I was saying is that you can use the parallel channel tool, one of our first tools that we have introduced, to identify your ranges and trade them. And yeah, you can see that this gets very much respected. Middle of the range, lower range, I didn't put it perfectly here, higher range, bounce off the middle of the range, lower range. Let me fix it so it looks better. Once again, middle of the range, middle of the range, middle of the range rejection, lower part of the range, flip the middle of the range, go to the higher range. Once again, low, towards the middle, middle again, lower, up. So as you can see, this is very respected, and it's a very, very simple strategy. Once again, look, we go above the range, we fake out the range, go back below. For example, this would be a short trade with other stuff that I will explain. Don't go off the chart now and start buying every single like fake out of the range, because it doesn't work like that. You need volume, you need to look at other things, you need to have confluence. So don't start doing that. But yeah, I'm just giving you a very basic, simple example of why there's so much money to be made off of these ranges. Look at this, SFP of the range. Boom, we can trade it to the middle of the range, take profit here, then get stopped out on the rest of the trade here. Once again, low of the range, trade it to the middle. Once again, low of the range, trade it to the higher part. Here, take a short. Once again, fake out of range low, take a long right here. Ride it up to the middle of the range where we take profit. Once again, low of the range, take the long, bring it to higher part, etc., etc. So as you can see, like most money, we just had like probably 10 trades to be taken inside here. Now, this is not mainly what I do because I'm a swing trader, but you know, a lot of people make money just trading this, taking 10 trades. You lose 3, you win 7, and probably the majority of the trades that you win are going to be like 1, 2 to 3. So this is why trading ranges is very, very profitable. So yeah, I hope everything is clear. and you have 2 more free lessons left. So next time I'm going to cover, let me see in my plan, I'm going to cover support and resistances, where I'm going to be introducing horizontal levels for the first time. I don't use trend lines, I use horizontal levels and other stuff. So I'll be introducing that, which will give you a pretty good base for identifying the first support and resistances. Then I will give you, I think, along with that, my daily routine on what I do. And then I will do, in the last lesson, a consolidation. So basically the range, along with swing failure patterns and failed auctions to a very, very basic level. So with all this stuff, after 4 lessons, you should be able to identify any trend, you should be able to identify any chart, and use a very basic level of the SFP and the failed auction strategy and trading ranges in order to make your first trades alone. I wouldn't recommend. I would only recommend that you start trading on your own if you have done my full course. But definitely once you have looked through the free lessons and you have studied them properly, I can guarantee you that you will understand 90% of the stuff that I send in my Discord for free, which I will remind you once again, I have a free Discord that you can access by simply signing up to my exchange, which is Blowfin, with my link. All you need to do is connect your account to the Discord and you will get access for free to all my trades, such as these. As you can see, I'm pretty profitable. Made $400 here, made 700 here, 500 here, 3K today. Those are pretty low numbers actually, 1K on the Bitcoin short. See, you will start understanding and following what I'm basically saying here, or what I'm explaining here, or this short trade. You will start understanding all this stuff, which I know that most of you just come on my channel and they're like, oh, he's long, I'm just gonna randomly go long. I don't want you to do that. Like, sure, you can do that, but wouldn't it be much, much cooler if you actually understand every single time I send something, you're like, oh, I know what he's talking about. I wouldn't be able to come up with it on my own yet, but I know what he's saying. And I'm going to follow him because I actually understand. Because I can guarantee you that when you're trading and you don't know what you're doing and you don't know why you opened that trade, it really fucks with your emotions. Like, imagine if I was following someone else and I open a trade, I'm long on Bitcoin. I'm like, okay, I have no idea why I'm long, but this guy is long. So, and I know he's pretty good, so I'm going to go long. But in the moment when this trade starts going wrong, I start doubting him and I'm like, oh, what the fuck? Maybe this guy is a bullshitter. Maybe this guy's an idiot. I don't really trust him. I'm losing $100. Fuck it, I'm out. I don't want to lose more than 100. And so you start doubting yourself and it really doesn't help with your emotions. But in the moment in which you see my trade and you're like, okay, I see what he's doing here. He saw the market structure shift. He saw the horizontal level. There's an SFP, there's a failed auction, which I understand why it works. Logically now I know that there's people who shorted and who are stuck in their losing position. So I'm going to take it long because there's higher probability that it will work out. Of course, I'm conscious that it doesn't have to work out, but I know where I'm wrong. And I know that the highest probability is for it to actually work. And so at that point, it really helps with your mind to stay in the trade and to do things properly. So that's why I want to give you this basic course to get you to a level when you can just follow everything I say, understand it, and replicate it. So that when you open your phone, you're not like a little noob who's like, oh, I don't know what's going on, but fuck it, I'm making money, or oh, I'm lost this much money. Because also when you don't know what you're doing, you start getting pissed at me. You're like, this guy's a retard. Like, he doesn't know what he's doing. I'm not a retard. I just know how trading works. Sometimes I take losses, and I want you to be conscious about all these things so that you can properly follow me and actually achieve success. So yeah, to sum it up, I rather teach you how to catch a fish, and this way you can fish on your own forever, rather than give you the fish. If that's the sentence, I don't remember, something like that. So yeah, I hope everything is clear. I hope you enjoyed, and I will see you in the third free lesson. Hello everybody, and welcome to the third free lesson of my trading mentorship. I actually already recorded this once, but my screen record did not work. So this is the second time in a row that I am recording this lesson. But anyways, in the last lecture, we saw how to identify market structures. So at this point, you should be able to identify the trend, look at the general picture of the market, and decide on which side of the market to be on. However, what you need now is to be able to do a technical analysis, a very basic technical analysis, and find the level of support and resistances where you can place your trades. Because of course, technical analysis is all about finding those support levels where price could bounce from and resistance levels where price could reject from. So what you would typically see from most people that are trying to teach you how to trade is trend lines, right? Stuff like this, where they're basically telling you every single time that the price goes back to the trend line, it is a support levels, look for the bounce, buy, and make money. Let me tell you already, I do not absolutely use trend lines for trading. I never do this, and I'm not going to teach you this, and I don't want you to trade with this. The only thing that we will use trend lines for is to identify certain patterns and to trade, for example, triangles and stuff like this, which, by the way, I don't trade like the typical way, such as this and looking for a break. I actually trade them with fake outs. And yeah, anyways, this is more advanced stuff that I will cover eventually. For now, it doesn't matter. But just to give you a little bit of an intro, you have a trend line when there is two touches on a line. So for example, 1 and 2. And you have a confirmed trend line when this trend line is touched on the third time. So for example, here. Anything before that is considered a speculative buy. But yeah, anyways, you really don't need this once again, but I'm just giving you the very basic concept of a trend line. Why also do I not trade with trend lines? Trend lines are basically open to interpretation. You could be tracing them from like the wick to another wick, or maybe you don't like it, so you switch it to the body and to the wick, and then on this one it's the body, but this one is not working out, so you go back to the wick. So there's no general rule for tracing trend lines. It's kind of like open to whatever you think fits better. Whereas the levels that I trade and that I'm going to introduce in this lecture, they are levels that are not open to interpretation. There is a very simple rule to follow. And by the way, the levels that I'm about to introduce, they are called horizontal levels. So we have horizontal levels, and we have three types. We have one daily levels, 2 weekly levels, and 3 we have monthly levels. And of course, as you can guess by the name, all of these will be found on different time frames. Your daily levels will be on the daily time frame, your weekly levels will be on your weekly time frame, and your monthly levels will be on your monthly time frame, which is what I made you save in the last lectures in your favorite time frames. So the most important thing is to start from the higher time frame, so the monthly. Remember that, as I've already explained, HTF, this means higher time frame, always has control. So monthly is more powerful than weekly, and weekly is more powerful than daily. All right, higher time frame equal stronger level. Okay. So the very basic rule to trace out these horizontal levels, it's very simple. For support, what you want is a red candle followed by a green candle. Okay, so as you can see, we have our first support level here on the monthly time frame. We're on the monthly, and what you want to do in order to trace these levels out is to use the horizontal ray. So you can get this from your toolbar here, the horizontal ray, put it in your favorites, it will appear here. And so as you can see here, we can look at the most recent price action. We have this red candle. Don't forget that my candles are gray for red and white for green. So here we have the downward candle, and here we have a green candle. So this becomes our first monthly level. So what you can do here, you can click on the line that you put, you can decide a color. I typically do purple for monthly, yellow for weekly, and blue for daily. You can put your text, you can write your monthly level, and then very important, you click on it, you go to template, you save drawing template as, and you can name your template, for example, as monthly level. This is how I organize my levels. I have daily, weekly, monthly, all in order. Of course, these are other things that I will teach later on in my advanced course, and POCs and value area highs, etc., etc. But yeah, so like this, we have just traced our monthly level. Now, where do we see another valid monthly level? I can already see one, and it is right here. These are our two monthly level supports. You're probably asking yourself, why am I not tracing the support right here? This is also a monthly level because you have a red candle and a green candle. So you have the red candle followed by the green candle. Nope, that is wrong. I mean, this used to be a valid monthly level, but what you want to be looking for are levels that have not been touched yet. So they're called the naked levels. You see, this monthly level has never been touched again ever since we have gotten it. There's no price action going through it. Same thing for this one. Here, price never went down and tested this level, which means that it is a naked monthly horizontal level. And those are the ones we care about. For resistance, very simple, very, very simple rule. It is a green candle followed by a red candle. So on our monthly frame, you can see here, we have a green candle followed by the red candle. By the way, there is a crazy pump on Bitcoin at the moment. So normally this would be a monthly level, but remember what I just said, this level has been touched already. So it is not a monthly resistance level anymore. It used to be, right, when we were still here. For example, when price action was like this used to be our monthly resistance. But in the next 2 months, once the price has been touched right here, this is no longer valid. We don't care about this anymore. I mean, we keep it for a little bit, just in case we see a reclaim of the level, and that's what it's important for. But eventually, for when now we fast forward about 6 months or so, we don't care about this level anymore. So you don't need to have this on your graph. And now, of course, Bitcoin is basically an all-time high, so all the levels have been blasted through so that we don't have any resistance monthly levels. Also, another thing that I want to note, of course, price action is very far from this monthly level here. Like, we don't really need this monthly level on our charts because we don't really expect price to go back to $82,000 anytime soon. So it's not very relevant at the moment, but we can just keep it on the graph for future reference. For example, you can just keep it, you can hide it. As I've shown you before, you go into your object tree and you can just hide it and keep the most relevant levels that are closer to our price action. And then maybe in 3 weeks, if we're trading down to 90,000 and this becomes more relevant, so you can just add it back. Obviously, if price keeps on going down and down, you can start tracing the other ones even more down. But of course, for now, we don't need to trace those levels at 25,000 or those levels. Can't tell if this one has been touched, but yeah, it looks like it. But yeah, so, what we need at the moment is the most recent ones. And as I've said, we start from the monthly time frame and we go down to the daily. So next we go on our weekly. And already here, we can see that we used to have a weekly resistance. Why is this a valid level? We have our green candle followed by our red candle. And we also have another weekly level right here, exactly on our monthly. Typically, when this happens, I just don't trace it. I keep the monthly level, because as I've said, the monthly level is stronger. However, this weekly right here, which by the way, little trick, this is not valid yet. Look at the candle. The candle still has 2 days and 8 hours to close. Therefore, we're not going to trace this yet as a weekly. Why? Because if in 3 days, basically, there's almost 3 days left, this price action actually comes down to, for example, 108. This candle is not going to look like this anymore. It will look something like a wick with the open here, right? And then if it closes at the monthly, it would look like this, another red candle, right? So this wouldn't be a weekly level. So yeah, little tip, wait for candles to close before marking out your levels. So where do we actually have these weekly supports? We have one right here, as you can see, a red candle followed by a green candle. As you've probably noticed by now, it is always at the close of the red candle met by the open of the green. And that is for support. You see, we open the candle here, we close it here, the next green candle opens here, closes here. Your weekly level goes where we have the close of the red met by the open of the green. Obviously, I have gray and I have white. I'll repeat this again. So that is our weekly level. We also had a weekly resistance right here because, look at this. This time we have the close of the green candle met by the open of the red candle. So this is visually what you have in order to trace a horizontal level. But if you want to make it simple, you can just look at the last green candle followed by the red one. But if you want to consider the open and closest, this is exactly how it is. So you can take a screenshot, you can write it down in your notebook, do whatever you need to do in order to remember. However, as I've just explained, this weekly level is no longer valid because we have already tested it many times. It is okay to keep it for a little bit because sometimes these levels get retested, they get flipped into support right here and retested, and I will explain this in a little bit. But eventually when price is here and it's already been retested, you don't need to have it. So this would not be valid. And then we have these very distant weekly level right here that once again, we don't really need. Then one thing I want to show you, because I actually traded this weekly level, I'm just going to show you on my actual Bybit chart, is the weekly that we had right here at 119, 316, in order to show you how well respected these levels are. And because I actually traded this the other day. So as you can see, this weekly level was approached and we had a very nice rejection. Then we struggled to reclaim it. And once we did go above it, we even back tested it. And this should already show you that these levels are very well respected. I mean, it's pretty crazy that we hit it as resistance and then we have a little bit of a retracement. We then go above it and now it becomes support. And once again, I'm going to explain this in a second, these support and resistance levels. But first, let me finish covering the dailies. So for the daily levels, of course, we go on the daily time frame and look at this. We're actually hitting a daily level right now. This is live. So we have this daily level right here that we got into right now. And then the other daily level that I see is right here. Right? One here and one right here. And once again, why is that? Remember the simple rule. Red candle followed by green candle, red candle followed by green candle. There is another one here, as you can see, that has not been touched. And remember, all these levels have not been touched. This is no longer relevant. This used to be a daily level, but look at price action. We already tested it and really blasted through it. So no longer relevant. We only want to keep the levels that have not been touched yet. So this for now we will keep because we might of course flip it into support and bounce. But for now we will keep it. Especially for daily levels, you want to keep the most relevant ones that we have in the closest price action. For example, this is our price action. We don't really expect price to fall below 100,000 in the next day. I'm going to stick to the most important daily levels that I have in this price action. And let me explain why we only keep the levels that are untouched. Well, the reason why is because if price comes down, right, to this daily level, we obviously will have some buy orders. This is how it works. This is how support is able to be support, because we have people that are willing to buy in this area. And as price starts to approach this support level, these orders, these buy blocks, let's call them, they start to get filled, right? And so due to all the orders that are here and people aggressively buying, we will have a bounce. Now, if we go and test this level again, this time, after the buys have already been absorbed, we will not have as much buys and people willing to rebuy this level as we had before, because now we already filled these orders here. So now there's not as much. And so the more times that we keep hitting this level, the weaker it gets. And so eventually, if we test this level too many times, the likeliness of breaking through it becomes higher. And this is exactly why we only keep untouched levels. And another thing that I already showed you in the last video, but I will repeat it. These levels you want to save into a folder that we can name HTF for higher time frame levels. This way, when you want to have a cleaner chart, we can quickly remove them and see nothing on our charts. And when you want to add them back, we can just add them. So now let's go through support and resistance flips. Also very important to note that these horizontal levels, yes, they are considered support and resistance, but these are not the only levels that I trade with. So when this lesson is over, I don't want you to go and put all the weekly and daily and monthly timeframes and put all these weekly and daily and monthly levels onto your graph and start trading them. I mean, yes, this could work. Like for example, here, as you can see, this is so well respected here and here. But typically, for how I trade, I don't want to just see this as my support. Support is typically for me made up of 3 confluence levels minimum, otherwise I don't trade it. Confluence basically means that you want many reasons why that level can hold a support, not just one. This is just one confluence. Having a weekly is one reason why this is support. But then, for example, I have a naked point of control that is lining up with it. I maybe also have an anchor VWAP that is lining up with it. So I'm not trading just off of these weekly levels. I use confluence, so many levels, at least 3, lining up for finding my support levels. But those will all be covered in my advanced courses. So for now, I'm just giving you my horizontals. Anyways, as I was saying, you can see how well respected these levels are. And the important thing to remember is that when support is broken, it becomes resistance. And same thing for resistance. When resistance is broken, it becomes support. And you can clearly see this right here, right? If we assume that this weekly is our resistance, right here, before we've touched it, this is a weekly resistance, don't forget. And once again, we're assuming that it is resistance based on one level, but in reality, normally it would have at least 3 levels of confluence. But for the sake of this example, this is our level of resistance. So as you can see, price came, it touched it perfectly, had a little rejection, it broke it, and then we had a flip into support. From this moment, we held a support and had continuation. And so this is a perfect example of resistance being broken and becoming support. Look, I mean, it literally cannot get easier. We had resistance, it gets broken, support, bounce. This is what typically happens. These back tests right here of the levels are where usually, they're called back test, don't forget, back test. They are typically what you want to see in order to confirm that the resistance level has now been flipped into support. And what happens when you get this? Typically, you get the continuation to the upside. And in fact, look at this, look at Bitcoin completely pumping from the back test of this weekly level. So if this does not happen, let me go back in time. If, for example, we don't get the follow-up, but we actually get a move back below this level, then this, in this case, is not a back test. This is actually a loss of the level, and this is what is considered a failed auction or a fake out, which I will cover probably in the next lesson actually, to a very basic level. And this is the trigger to a short trade. This is also why it's so important to analyze those support and resistance flips, because if we don't have a flip, we typically have a fake out, which means a new trade. And keep in mind, once again, I know I repeated it, but keep in mind that for these flips, confluence is very, very important. You don't want to just flip a weekly. You want to have more things to look at. And those could be, you know, like naked point of controls, which I'm not going to cover here and they will be in my advanced course, or value areas, or I don't know, Fibonacci levels, etc., etc. Anchor VWAPs. You know, there's a lot of tools that I will cover that will make up my support levels, where all these theories that I'm explaining can actually be applied properly. And imagine how good that will be if already just a simple weekly level can show you how well it is respected. Imagine when we add all those things that I just explained. Anyways, let me show you another example. Look at this, for example. We had the support, as you can clearly see. We touch it once, twice, 3 times, 4 times, 5 times support. We finally break through it. Guess what? We go back up, we get the retest or back test. This can be called retest, or as I explained before, a back test. This is our confirmation that this support level that we had right here has now become a resistance. And look at that, from there we have continuation to the downside. A perfect support into resistance flip. I can see another one right here. We had this resistance once, resistance twice, resistance 3 times, break the resistance with ease, back test it, continuation to the upside. You see this all the time. So once again, I want you to go now to a chart and find these levels and start like flipping them, because sure, it may work by coincidence on some levels, but typically you want the confluence in order to do that. Also, one thing that is very important to note is not that we are blindly trading these levels. For example, here I had my daily horizontal level and a daily NPOC, and I'm going to give you a little sneak peek for those people that will get the mentorship and what it will be like, and the type of templates that you will have access to. So to find these naked point of controls, you will have these templates that obviously I will teach you how to find. But this is what will help you also find other horizontal levels that I will explain in the future and that are very, very powerful for trading. But anyways, by the way, this pump is actually insane. But anyways, when I have these levels, such as this daily lining up with the NPOC, lining up with this value area high, for example, I am not blindly trading them. So what most of you unexperienced traders would do is, okay, I have my resistance level, I'm going to go short as soon as we reach here, right? Let me go on the lower time frame. I'm gonna go short because this I identified as a daily resistance level and a naked point of control. But no, if you want to have the highest win rate and really understand the market and trade those levels to the best chance of getting them right, you want to be looking at order flow. And that will be things such as open interest, volume, delta, and stuff like this. Like for example, of course, now you're not really going to understand what I'm talking about, but when it gets to a resistance, I will be looking at the order flow. And if I start seeing delta going up, huge volume showing like a lot of interest and buyers, aggressive buyers buying this level, and then I see that open interest is also increasing. So this is why order flow, which I will eventually cover later on, probably lesson 6, 7, or 8, I don't know, but eventually will be covered in this mentorship. It can really help you avoid taking these losses because you have you who has identified this resistance level and is just gonna blindly buy it. You get into your trade and boom, stopped out within 30 minutes, you're out of this trade. And then there's me who is literally monitoring it, zooming into the candles, looking at order flow and saying, okay, what's going on? Are people interested in this level or is no one actually shorting this? Like what are people doing? Are they buying? Do they think that this is a shit level that we're not hold? Or do they think that this is a very big, important resistance level? And that's where, for example, we can see a reversal. So I'm gonna increase my chances based on using these tools of the order flow in order to look at those things. And it can really help you with the resistance and support flip. Like you're not only looking at this, making this type of movement, you're also looking closely, like, what, are we having absorption here? Are there people buying or is everybody shorting? What's happening with the volume? What's happening with the delta? And this will help you increase the probability of whether or not this is going to keep getting continuation or perhaps is getting a fake out. Maybe there is a lot of longs opening here, but those are longs that are getting trapped. And therefore we then backtest the weekly and keep going down. And then you have a fake out instead of randomly opening trades. So this is why it is so important to not just look at things as they are by just looking at support and resistance flips or a weekly level and that's it. Like there's so many things that we need to put together in order to really predict what could happen and increase our probability of being right. So there's a lot of these things that you want to be mixing together in order to get those things right. So I think I've covered most of it, I hope. By the way, look at how beautiful. We're probably about to get a new all-time high on Bitcoin. Quite funny because just yesterday I was saying that I added it to my spot longs. Now I'm not going to be trading much these days since I'm recording this course. And that overall, I'm expecting a new all-time high. And we were still at $118,000 when I sent this message. And almost a week ago, I was saying that if we remain above 112K, I expect next target to be 120,000. And we were still trading on 112K at this point. I don't want to say that I called it, but I called it. So very, very simple. What I do every morning, I wake up and I go into my higher time frame and I start marking out my levels. I see what's close to my price action, starting from the monthly, I go down to the weekly. I mark out all the new levels that I have. Then I go on the daily. Then I go on my little secret naked point of controls. I check what I have. For example, I have something interesting coming up right here, 120, 118.7. I go back to my chart. I put my levels. I have my daily negative control, which once again, I haven't covered, but I will eventually in my advanced course. And the other one was like at 118. I identified the trend. We are clearly in an uptrend. Even on the 4 hours, we're on an uptrend. 30 minutes, we're on an uptrend. If you have listened to my previous lecture, you should know that in an uptrend, we want to look for buys on the dip. So what am I going to do? I'm going to identify my possible support areas with the different tools that I typically use. And for example, identify that I have an interesting support here on this naked point of control, on this anchor VWAP, and on this very area high, and that I will be looking for this price to either go down here and to remain patient in order to take my long and take this, for example, to a new all-time high, or for example, for this trade to line up with my confluence levels. If we reverse here, I probably even have a nice Fibonacci. And in fact, if we were to reverse here, I would have my 0.75. And once again, this will make sense if you go through the whole course. Or for example, from here to here, I also have the 0.75. And at this point, I'm doing something very quickly, like just to show you, for example, what I would do. This is not even like a proper analysis. I'm just giving you an example. So don't try to like decode what I'm doing here. It's not even correct. But I'm just telling you, like, I'm gonna find my confluence levels, things that line up, and I'm gonna look for buys on the dip. And then I'm also gonna keep in mind, for example, okay, we're reaching a new all-time high. What could happen at all-time high? I'm going to mark out the all-time high, and I know that we could do a simple SFP and go back down, or we could chill above for a little bit, do a fake out, so a failed auction, and all of these two strategies will be explained tomorrow to a very basic level, but that will still be able to make you do your first trades and understand how they work. And so now, based on this, I will have my trading setup for a long in case we get to this price. So what I would normally do, I would set up my alert right here. I then have an alert for all-time high, as that is also the most probable thing that will happen next. And then I will have my plan. Okay, if we go above all-time high, I am looking for two types of trades to possibly short. And if we don't get them, for example, if we stay above all-time high and never go back down, then I'm expecting for continuation and I just won't be doing anything. I'm already positioned in my longs and honestly making a shit ton of money at the moment. But yeah, it's very, very simple. I don't need to be looking at the chart every single minute and seeing what price is doing. I simply have my alert here. I have my alert here. And I'm just waiting for some of these levels to be hit. If they don't get hit, it's fine. Tomorrow's a new day. I will have new setups. So yeah, very, very simple. I identify the trend. I identified my support. I identify my resistance. And that's it. So I hope everything is clear. Next lesson is going to be the last one. I hope you have enjoyed so far and you're getting to a point where you're starting to understand how to see the things that I'm doing. And hopefully by the next lesson, you will be able to be taking your first trades. And of course, if you want to take it to an advanced level, I suggest that you keep going with the paid version of my advanced course. So yeah, I will see you in the next video. Make sure you watch this video maybe even more than once to fully understand and come to the next lesson well prepared. Hello everybody and welcome to the fourth and last free lesson of my trading mentorship. This is probably the most important lesson where I will be teaching you one of the best trade entries, which hopefully by the end of this video and having watched the other 3 lessons, you will be able to finally open your first trade that makes sense. That means a trade that is actually backed by technical analysis and it makes sense in terms of positioning in the market and risk to reward. So from this moment on, you might be able to start taking trades that only make sense and stop buying or shorting random spots in the market. What I will be covering today is swing failure patterns. Swing failures patterns, also known as SFP. This is actually one of my most used trading entries. And when it is mixed properly with order flow, which we will not be covering today, but when it is mixed with order flow, it can give amazing trades with an amazing risk to reward. And this can also be used without order flow. It is obviously not as powerful, but it is the simplest thing that we can learn without using all of this. So the first thing we need to introduce in order to understand swing failure patterns is liquidity and liquidity zones. So how does liquidity actually work? You have two types of orders in the market. One is called limit orders, and two, I'm sure you've heard of them, market orders. So limit orders provide liquidity into the market. Market orders take away liquidity from the market. Let me make this a little bit more simple. When you take a market order, you are basically accepting whatever the current price is. For example, here on Bitcoin, we are at 124,895. If you open a trade here at a market order, obviously it depends on your size, but typically your trade is going to get the entry of whatever price is available in the order book, which is someone's limit order. So you're basically accepting an offer from someone who placed the limit, and your market order is matching whatever offer there is. So you're filling these liquid orders, and therefore you're taking the liquidity out of the market because these orders are getting filled and they're no longer in the order book. And yeah, that's why you're taking the liquidity away. Limit orders, on the other hand, obviously, as I just explained, you are placing this in the order book, okay? Imagine this is the order book where there is, at these prices, there are these orders, and therefore you are providing offers and liquidity into the market. And you're waiting for someone to be willing to pay these prices for your orders to be filled. So, why is this important? Because there are larger traders, so not you, because you're probably not trading with 10, 20, or 50 million. And these large traders right here, they need the liquidity in order to participate in the market. So let's imagine that we are trading with $20 million, okay? We want to open a trade with the value of $20 million. Let's make it like this. And imagine that at the moment, it's the weekend, let's say, where there's typically lower volume, and we're just ranging. And we're averaging, let's say in this range, $3 million in volume. You can see that there's clearly not enough volume to fill our $20 million size. So let's say that we want to go short, we would have problems filling our whole position, because with this low volume, you're never going to fill $20 million worth of positions. So if we want to go short here, how much do we actually get filled of these 20 million with such low volume before this moves in our favorite direction, and the direction that we were hoping for in order to make money off of our $20 million position? So obviously setting limit orders right here does not make sense, because they're not going to get filled. There's just not enough volume, there's not enough orders for us to get the full position. On the other hand, if we start using market orders of $20 million in a volume range that has 3 million, we would obviously start crashing the price as we set our orders. 1, 2, 3, 4, 5, 6, 7, 8 million, etc., etc. Let's say that we had planned our short entry at 100K, right? If we start market ordering shorts in such a low volume range, by the time that we actually fill these 20 millions, perhaps our average entry will be at like 97.5. I'm just giving examples. I don't know if this is actually what our average entry would be, but you basically would have your entry all over the place, because you would be crashing your own price, and then you would be getting filled lower and lower and lower and lower. And then perhaps a 97.5K, it's a great support. And there's actually buyers that will push the price back up. And at this point, you just lost a shit ton of money. So what if we were to find a place where there is enough market orders, which, remember, they take away liquidity from our limit orders that we would be placing $20 million off, and have enough of these market orders in order to fill our position without any issue? We need to find a place where these market orders are just sitting. This way, they hold up the price against our limit orders of 20 million. And let me tell you where these places of high market orders are placed. So if we're trading in such a range right here that we've actually covered in the previous lessons, we can assume that most traders that bought this downfall, that they have placed their stop loss below this low, because they like to place their stop loss in a technical sense under lows, something that makes sense and makes them feel safer. And so we know that here there are stop losses. And let me explain what stop losses are for traders that went long. So stop losses are simply market orders in the opposite way of the trade. So for example, people that bought here, they have to set short orders, market short orders, in order to get out of their long in case the price goes to their stop loss. Okay? And the same thing applies when you go short. So if you go short, that means that your stop loss is going to be the equivalent of a market long order. Why? Because in order to get out of your short, you need to buy back the positions. And in order to get out of your long, you need to sell your positions. So the people that bought here, they have their stop loss set, and it is set as a market short order. So once price goes back below this price, right here, where we have the wick and where we have all these stop losses, as you can see, this happened right here, it triggers all these stop losses, which means it triggers all these market short orders, and it gives the opportunity for the larger traders to fill their limit orders with the opposite orders. So all these stop losses, let's not forget, they are short orders, and you got larger traders right here that are filling with their limit buy orders. So now you have these big traders absorbing all these stop losses, filling their positions to look for the reversal of this range. And this is exactly what an SFP is, also known as swing failure pattern, also known as stop hunt, because you're hunting for the stop losses, or even liquidity grab. And we can actually see another one right here and another one right here, which led to reversal. And typically what you want to do is trade these little setups to the other side of the range. So typically they originate as a scalp trade, but you can actually transport them into swing trades. Then once again, another small SFP right here, which led to the other side of the range. Then break of the range and a bigger flush. So this gives you the opportunity to get into these nice high risk to reward trades to the opposite side of the range at first. But if this range is broken, these can develop into very, very nice swing trades, which can even result to 1 to 12, 1 to 15, 1 to 20. I've had crazy trades thanks to this method. And typically this works very well, as I've said, in ranges where there is consolidation moments, where the price is undecisive and people start buying and selling and start placing their stop losses above and below the range. This is where this works best, and this is where you will find it most of the time. And as I said, it can happen on lower timeframes and higher timeframes. Typically, I use this on the 30-minute, because I'm a swing trader, on the 1 hour, and on the 4 hour. You can even use daily if you wish, but those are my preferred timeframes. And then of course, this can also happen for scalping, smaller ranges, etc. You could trade this, for example, on the 5 minutes, on the 15-minute, whatever you seem to prefer. However, as I said, you will mainly see me trading on these timeframes. So let me explain exactly what you want to see. So let me put in some rules. First of all, you wait for price to take the high or the low of the range. 2, most important part, I'm going to give you the example where we are taking a long. We wait for a candle closure above the previous low. So if this is our SFP right here, okay, this is the low that we're taking into consideration. We can consider this here. This was actually 1 SFP, 2 SFPs, 3 SFPs in a row. One of which would have resulted in a win, most likely, if you took profit correctly. Second one would have resulted probably in a loss, unless you took profit at the middle of the range. And the third one would have been an amazing trade. And then the fourth one here, the short, would have made you a lot of money. Anyways, what you want to do is for the 30-minute candle, or 4 hours, or 1 hour, of course, the higher the time frame, the more powerful it is. However, it also gives you a later entry. But anyways, on the 30-minute, what you want to see is for the candle to close right here. This is the close of the candle. Remember lecture 1 for the candlesticks. You want this candle to close above this reference level, which is the low. So as you can see, we wait for the price to go below the low. This is where all the stop losses are triggered. And you want to wait for the closure. So technically here we have the valid entry with the stop loss below the low, targeting the range. This specific trade actually did not give us a great risk to reward because the wick was very massive, but typically you would have setups that look more like this. For example, if we take into consideration this trade that this time didn't play out, but normally you would have closure of the candle, entry here, stop loss below, and targeting other side of the range. Or for example, right here, this is probably the best example that I can give you. We take the high right here, the candle close is right here, and this would have actually given us a valid short entry with stop loss above the high, targeting the other side of the range, right below this low. And already this would have been a 1 to 11, as I showed you before. So number 3, take profit at the opposite side of the range or other confluence that you may have. And then 4, let the trade run in case of a market structure shift for a swing trade. Now, another reason why these are not the best SFPs is because typically you want to be taking these setups on levels that you have studied and that you found as support. So we do not take these setups on anywhere in the market, okay? Typically, for example, let me give you the perfect example from my latest trade. So you should know by now that I had planned a trade at 107. Look at this. We get to my area. Now look at this. I'm going to keep this on the 4 hours, but you can find this on the 1 hour and the 30 minutes as well. So we get to my interesting level at 107.5. We start ranging. We form this little range. And guess exactly what gave us the entry to probably one of the best trades. I was looking for all-time high when giving this trade. Look at this. We have on the 4 hours the low being put in, and then we go through the low, SFP, because we have the closure above. And by the way, if you want to be more aggressive, you go on the 30 minutes, and you can clearly see that we would have had a great entry right here. This is the close of the candle. We would have had a trade like this. I typically keep my invalidation a little bit more below the low because many times actually what you will see is that, let's call it an SFP 2.0, but typically price will come back once more to get the early longs. And all the people that place their stop loss right below, they get stopped out and then you have the real move. So typically what I do is I give myself a little bit more space, so I'll keep that in mind. But anyways, on the 30 minutes, look at the type of entry already that you would have had. So we would have had this entry with the target of opposite side of the range. For me, this was already a swing trade. So I was already targeting all-time high. And so if we are to target from our bottom entry to a new all-time high, which by the way, we did get eventually at 125, we would have had a 1 to 34 risk to reward ratio trade. And I took this exact trade. Okay, I literally took this. Of course, I took profit along the way, but I can show you because I literally posted this in my Discord today. Look at this. This, a 107.5 was my entry targeting 124. And look at that. That's exactly what I was expecting. And this SFP is exactly what confirmed my entry. And by the way, you don't even need to be like trying to snipe this, because actually the smartest thing to do, especially if you're not using order flow, would be to wait for the liquidity grab right here. And then you want to wait for a sign of strength, which usually you can see on the 15 minutes, 5 minutes, whatever you want. Of course, you are more secure to go on a higher time frame to wait for the market structure shift. But if you want to be more aggressive, you can go on the 5 minutes. And you can wait for the first signs of strength with the market structure shift. And at that point, you can enter your trade. Yeah, you will be a little bit more late, but it really doesn't matter. Like, think about it. Even if we were to wait for a market structure shift on the 30 minutes, right? We would have had an entry, look at this, our market structure shift would have been here, right? And as I've explained before, you wait for a little bit of a retracement. Let's say you don't ace the retracement perfectly, but you're able to get your entry after the market structure shift at 109.3. You can place your stop loss below the low now, because if it goes back below at this point, then you want to be out. And look, even like this, targeting a new all-time high, which is where we are right now, you can see you still would have had a 1 to 8 trade. So you don't need to be sniping the exact bottom. If you have a mentality of swing trading and you have way higher targets, you can really just be patient and take the most secure trades, which means wait for the liquidity grab, wait for the candle closure, wait for the market structure shift, and then take your trade. Obviously, taking on more risk and placing your entry right here, but maybe getting stopped out unless you gave yourself, for example, what I did is actually I opened here, but I put my stop loss like way below. I think I had it at like 105 to give myself space. Then once we changed the market structure, then I moved it down here. But yeah, you take more risk, you get a higher chance of getting stopped out, but if the trade works and you snipe it properly, you get a crazy return on your trade. Like you could have literally risked $100 on this trade right here with this exact entry. And let's assume you wouldn't take profit until all-time high, but you would have made $3,400 with just $100. That means if you risked 1,000, you would have made 34,000. And this is sometimes how you can see, for example, my P&L being like $20,000 on a trade on Bitcoin. And typically on these trades, I'm not like risking $20,000. I'm actually risking like 1.5 or 2,000. And so yeah, this is basically the strategy on how you can achieve those returns with a very, very simple SFP. So going back to our rules, take a screenshot, write it down, do whatever you need to do, but this is exactly the strategy that you would use without using order flow. Now, of course, maybe without order flow, this would work 60, 70% of the time. But if you were to use order flow, you could probably increase your chances of being right to 80, 90% of the time. And that's because we use certain tools by zooming into the candles to actually know when these SFPs are more likely to work rather than just using candlesticks and blindly looking just at price action. This is still a really good method to have entries, but of course, if we mix it with this, you would see a crazy change into your win rate and into the way that you take your trades. And let me explain why this improves so much when we actually look at order flow to an 80, 90% probability of working out if you make the correct decision, that is. Well, the reason why this is such like, let's call it the secret sauce, boom, secret sauce. And it really is like, guys, I'm not trying to like sell you anything. Like I'm just being for real. Like order flow is so powerful. It's crazy. It really helps you to decide when to take these trades and also when to avoid taking these trades. Because if what I just taught you, you would probably trade every single time you see it. But with order flow, there will be like 2 or 3 times where you're like, nope, this is not valid. I'm not going to take this. But if you weren't looking at that, you would just look at the candles. You'd be like, oh yeah, this is an SFP. The candle closed above. But if you were to zoom in on the order flow, you wouldn't see those little things that would tell you, for example, okay, yeah, this is 100% like a valid swing feather pattern. And basically what you want to see, I'm not going to explain exactly how to read it because it would take me a while. And it's not part of the free version of this lesson. But basically, just to explain it logically, of course, you still want to see all these things. But then one, you want to see trapped traders at your point of interest. So millions of orders. And this means that if we have a range and we want to go short at the top here after SFPing like this, right here is where you want to see all these trapped traders, which in this case, they need to be long market orders. You want to see a bunch of these stuck at the top. Is not that you can only see long market orders, but you can see if there's people getting stopped out. So you can see if all the shorts before they're getting stopped. You can see if there is a lot of new people taking longs, so the trap traders getting bullish at the top of the move. And that is actually the perfect mixture for a price reversal, because now you have the trap traders right here who took longs, right? And they're expecting for price to pump. Then you have all the people that took shorts here that are now out of their position because they just got a stop loss. And so the reason why it's a perfect mixture is because all the people that got stopped out and that wanted to go short, they now need to re-enter their market, which this will increase the short trades that we see as price falls. Then all these trap traders, they're long, they're expecting for price continuation. And remember, the stop loss of these trap traders who went long, it's more sell market orders, which means that you have even more sell pressure, and that makes the perfect scenario for price to keep on going down. So one, as I said, you want to see these trap traders as market orders going long at the top. Two, you want to see people getting stopped out. And three, you want to see new orders coming in for your favored side. So that means if you're going short, you want to see more shorts, people entering new shorts here. So there's demand to go short. And yeah, that's pretty much it. It's very, very simple, but actually seeing it onto the order flow is a little bit more complicated. And I will give you access to these templates. I will actually pay for you to have order flow access and these templates so that it won't cost anything to you if you take part into my membership. And I will teach you to read this in a way where you can actually see what is going on. So let's look, for example, very quickly. I pulled up exactly the trading setup where we had the SFP. You can see this was the low and we went to SFP right here. This is exactly what I just showed you on the chart. And this helps you to see all these orders that are coming in at the lows. By the way, there's other things which are shown here that help you understand if it is a valid SFP. This is actually not the best one that you can see on the order flow. And this is why order flow doesn't always help you to take these trades, but most of the time it does. But yeah, so what you want to see is all these orders. We can zoom in more here. So what you want to see as price is going down is for shorts to start opening. So you can see the net shorts are increasing. You can see here we had 23 million new shorts, 16 million new shorts here, 2.2 million. And so all these people shorting at the bottom, right? Once, as I've explained, once price goes back above, they start to be in a loss and they're going to start freaking out. They're going to start triggering their stop losses. And look at this, as price is falling, there's all these longs that are getting closed. That's people getting out of their long positions because they're getting stopped out. Remember, it's people getting out of their long positions. This is net longs. And so now at the bottom, what we have is not enough people that are long and a lot of people that are starting to get short. This is exactly what I just explained. It is the perfect scenario for price to start pumping. And in fact, you can start seeing that as price starts to pump right here, starts going towards 109, etc., you can see that now the longs are starting to increase. People are getting interested again in buying. And the shorts, look at this, minus 8 million, minus 4 million. These shorts are starting to leave. People are getting stopped out of their position. And how are they getting stopped out? With market orders. And so this starts a short squeeze, which lets price to start pumping. So yeah, this is a little overview of how you would read the order flow. Obviously, the very, very basic. There's so much more stuff to cover, like open interest, delta, volume, CVD. There's just so much to actually get to a good level of understanding order flow. And when it is mixed with this, I can guarantee you that you will see your win rate skyrocket. Like, it's a guarantee. If you understand it properly and you're using the right templates, you will improve your win rate to a crazy level. So yeah, I'll teach you this. Also, these templates will give you access to naked point of controls, which are also very important. Also, another thing that you can do as a beginner, if you don't know how to identify these areas of liquidity, you can hop onto CoinGlass on the Binance BTC USDT liquidation heat maps, and you can use this to see where most of the liquidity is laying around. So this is a little trick. Obviously, the yellow means there's more market orders and stop losses, let's call them. You can see here, we can see like the level of them. So the more yellow it gets, the higher the orders that there are placed. Obviously now we're at all-time high, people went short here, so where is their stop loss going to be? 126 typically. And that's why most of the liquidity is here. So yeah, you can use this on CoinGlass to help yourself to understand where the majority of the stop losses are placed if you cannot see it by eyes. It's good to refer to this. So yeah, basically I just gave you one of the best strategies to use. All these 4 lessons that we've done should really give you enough information and skills to start trading properly on your own. And of course, very importantly, this should prevent you from trying to always buy the bottom. There's no point. I know that a lot of you are buying all this downfall, when simply, instead of trying to buying the falling knife, you could literally just wait for the range, and you can just wait for the setup that I just explained. This will save you a lot of money and will also make you a lot of money. Now, as the last thing, I do want to show you inside my account, both to show you how to actually open a trade. And I'm using Bybit here, but I actually suggest that you use Blowfin because there's no KYC and you can easily sign up. Also, in order to follow my signals, you do need to use a Blowfin account registered under my affiliation. But anyways, the user interface is pretty much the same, so you will understand once you open Blowfin. But you basically have market and limit orders. Unless you're trading with $20 million, you do not need to use limit orders. Of course, you would pay less fees, but I typically prefer to use market orders. And also I want to show you, obviously, you're probably wondering, who the fuck is this guy to try and teach me? Why should I listen to him? Well, first of all, as you open my Bybit account, you can already see that I actually have let me refresh, just in case you think this is fake. So here's a little refreshment. So as soon as you open my account, you can already see that, first of all, I have $300,000 just laying around here for trading. Second of all, you can see one of my positions on Ethereum, where I've literally made $10,000 with an entry at 2.2 and still holding it now to 4.6. And so this trade actually just made me more than $10,000. My spot position, which was actually the same trade just in spot, but which you cannot see here, it actually made me $40,000, $50,000. You can see that on my Instagram. Anyways, as you can see, I have basically $500,000. So as you can see, I actually have almost $500,000 in one of my accounts because I actually have a little bit of sub accounts right here with more money inside. So I just showed you almost $600,000 that I'm trading with. So, you know, this is not to flex on you, to say, oh, look at me, I have $500,000 on my Bybit account. I don't give a shit. It's not even a crazy amount. I'm very aware that there's people that are trading with 10 million, 50 million, but I would say for the average 25-year-old to be trading with $500,000, you know, it's a pretty good thing. So yeah, this is basically to show you I'm not the first idiot that is trying to teach you how to trade. I actually do this for a living. I've been doing this since I was 16, 17-year-old. And I mean, my numbers clearly reflect my performance. And once again, I'll refresh this page, but it won't change. Actually, if anything, it just went up to 8,000. So just today I made $8,000. The last 7 days I made 15,000, and the last 60 days I made 47. I mean, sometimes I can get to $100,000 in just a month. For example, if I go on the 90 days, you can see I made $100,000. So, you know, I'm not trying to teach you some bullshit and trying to profit off. I technically don't even need the money that you would pay me for a mentorship. I have enough money to eat, and I actually know how to do this properly. So next month, I'll probably make another 20, 30, 40, 50, maybe $100,000. All this just to tell you, first of all, that it's possible. Second of all, that I'm not teaching you to scam you. I'm teaching you because I actually know what I'm doing. But yeah, anyways, you want to be trading on futures, and you want to be seeing your value right here. If I go with 0.1 BTC with 10x leverage, you want to keep this to max, I would say 10, 20x leverage. But if you're using the right risk management, which I taught you in lesson 1, you technically don't even need to be using all this leverage. For example, I trade with 10 max, but usually 5 or even 3, because I have enough margin to do that. But yeah, anyways, you keep it on the market. I would tell you at first to use isolated once you understand how cross works. Cross margin means that you're using your whole margin and you're putting your liquidation prices down. But you know, this is not something I really need to explain. You can look up a video on YouTube on how cross and isolated works. I don't want to waste too much time on it. And yeah, then you can set your take profit here. You can set your stop loss here. For example, if we are to go long right now, which by the way, I would never do. I would never long Bitcoin at 125,000 after longing it at 107. On the stop loss, you can set whatever number and it will tell you your loss, your expected loss, and your take profit, same thing. And then simply you press open long. I will open a very, very small long just to show you for educational purposes. You open long and you will find your trade right here with your entry, with the current price. And then you will be able to get out of your position. On your phone, it's actually much easier and much more self-explanatory. But yeah, so you should have every single thing set up. And by the way, of course, you want to have this money to trade on unified trading. Otherwise, you won't be able to open your positions. But once again, those are very basic things that you can find tutorials online, like for example, how to trade on Bluefin, how to trade on Bybit. So I don't want to waste too much time explaining it. But yeah, I think I give you everything. It's a shame that our 4 lessons have now finished. So what you can do now, if you do not want to pay for my mentorship, and it will include a lot more of these lessons to take you to an expert level, with the final goal of opening any chart and seeing exactly the same setups that I see and taking the same exact setups that I would take. So that's the goal. The goal is to get you to a level where you think and you see like I do. So yeah, if you do not want to proceed this way, do keep in mind that I have a free Discord where I send my trades, where I do live streams explaining why I'm taking certain trades, etc., etc. However, if you do sign up to the mentorship, it will include, as I said, all these lessons, and then you'll also have access to all my trading templates, my order flow templates. I will pay for your order flow membership in order to give you access to actually seeing it. And then you will have probably 3 private lessons with me where we will do charting together and where I will explain whatever you have not understood and whatever you need help on. So yeah, that pretty much sums it up. If you do not wish to continue this way, I think you have enough skills to follow me properly and to learn with time. But of course, do not expect to get to the same level where a student would get, because the student is going to get the whole package to become an expert trader like me, and hopefully to achieve the same results that I have achieved. And I can tell you that it's possible. Welcome to the first official lesson of the paid mentorship. The 4 lessons that you've watched are actually free for everybody, and they are to a very basic level. If you are watching this lesson, that means that you have officially paid for my mentorship. And it officially means that you are stupid. You just got scammed. Have you not learned anything about trading courses? Do you really think that if I knew how to trade, I would be teaching you? I hope you learned your lesson. I'm going to use your money to take some losing trades and gamble a little bit. But yeah, good luck on your trading journey. All right, enough fucking around. Let's get straight into it. So today's lesson is about indicators. Boom. And let me tell you straight away, I do not use indicators. You will never see my chart with a bunch of this shit. As you can see, my charts are always clear. You never see anything other than tools and price action. And so why do I not use these indicators? The reason is because they are laggy or lagging. You can say both. But anyways, indicators are based on old data. And therefore, using them, you cannot predict what happens next. But you are basically only reacting from what has already happened. And keep in mind that basically everybody's looking at indicators. Probably whenever I meet someone that doesn't know shit about trading, they're always talking to me about, I don't even know, like RSI, OBV, and this type of stuff. Like everybody's looking at that. Where is your edge? Do you really think that when the indicator, for example, the RSI goes above and shows overbought and you go short, and then when it goes down and it shows oversold, you buy, do you really think that works? Like everybody's using that, everybody's looking at that. And I never heard of someone that is profitable trading RSI, for example. And since they are laggy, they give the entry once the move has already started. So yeah, as you probably understood, I am not a fan of indicators. There are some indicators that you can keep on your charts, for example, simple moving averages, but this is more to have like an outlook on the higher time frame market, stuff like this, but we're absolutely not going to use them to trade. And also, of course, you can keep volume as an indicator. This is the only thing that I will accept you to have for trading. Then I will, however, cover 2 or 3 indicators that you can use as a beginner. I don't use them, but I know that they can help you when you're first starting out to understand some stuff. So, something useful for beginners. First one is the ATR, average true range. That's what it stands for. Why can this be helpful? It can be helpful for setting your stop loss. And the average true range is useful if you're a beginner because it measures how much, for example, Bitcoin has moved on average during a certain period. So basically shows you the range of volatility that Bitcoin has had. For example, here you can see that we have on the ATR 670, right? You can see it based on here. So typically when you take a long, you can use this to estimate how far you can place your stop loss in order to not get stopped out early. So if you know that the range is about $700, of course, you don't want to, for example, take a trade here at 121,500 and put your stop loss at 121,200, for example. Also keep in mind, we would never just be taking a trade here, but ideally you would want to keep enough space for your stop loss to not get stopped out by the typical volatility that there is. Obviously in this little range, the ATR has gone down to, for example, 328. So yeah, you can use this as an estimate of how much you can expect the price to move and to be volatile in terms of dollars. So of course, when the ATR is higher and there's more volatility, you want to keep a wider stop loss. And when there is not so much volatility, like for example in this range, right? If we go and take this range low right here, we know that the average true range is about $350. And so we can give, for example, we can have our entry here. Obviously, this is if we get a setup. And obviously, you would not want to be putting, I don't know, a $10 difference in your stop loss. But perhaps you want to be following these indications that are given on the ATR, and therefore adjusting the dollar amount on your stop loss based on how much volatility we have in the market. Then another indicator that you can use is the zigzag indicator. The zigzag indicator can help you figure out where your swing highs and swing lows are. So if you can't identify this, and this will be quite important for when we will cover Fibonacci levels, but it will help you understand from where you can trace these Fibonacci levels to then look at the retracements. Then the most useful one, I would say, is the visible range volume profile. So you can copy my settings here, 180 on the row size and 68. This can change between 68 and 70, but I would mainly say keep it on 68. So this can help you based on what you put on your graph to identify where in the range we have had the majority of the volume. Eventually, we will introduce fixed range profile, which basically means that you can do the same thing based on where you want. But for now, this is good to have on your chart because it works very easily, and it takes a little bit of experience to learn how to trace those yourselves, but we will cover that eventually. But for now, you can just put this, and based on what you're looking at, it will give you where the majority of the volume is. And you will get a point of control, which is the highest point of volume traded of this range. And then it will give you the value area high and value area low. And for now, what you can do is use this tool in Confluence to the horizontal levels that we've explained in lesson 3, I believe. Let's say that, for example, we have this daily level right here, and you can see that there's a very low volume node right here on this daily. There's not much volume that was traded. And so you can use this in Confluence to understand whether this level is more likely to hold or not. For example, on this daily level that we had right here, we can see that we had built quite a nice volume node. And so once we go back to it right here and we test it again, you can see that there was enough volume, and this is a high volume node. We can expect this to have a higher probability of holding compared to, for example, if we had the daily level that was showing this type of volume right here, basically nothing. Then in that case, you could expect this level to be traded through. So yeah, this is very simple to use and to help you with those horizontal levels. For example, you can see, obviously, even by eye, that the majority of the volume was basically traded around this area. And in fact, it is shown by all these candles that are showing that this is the highest volume that there has been. And that's why you have the point of control. And you can even see that, for example, this point of control is very much respected. We had the bounce here, then we lost it, we back tested it, then we come to it again, almost did not perfectly reach it. So yeah, as a beginner, you can use this, but when I will teach you to use the fixed range profile, then you will not really be using this that much anymore, or at least I don't really use it anymore. So yeah, remember that you can use this to match it with your horizontal levels, for example, on the weekly or on the monthly or whatever it is, in order to see if they could be stronger levels. Once again, if they're lining up, for example, with the point of control, there's a higher chance of them holding. If their volume profile looks something like down here, as you can see, much lower volume, then probably, for example, this level is less likely to hold. All right, you can see a clear difference between the volume that we have here and, for example, the volume that we had on this old weekly right here. You can see the volume traded here is much higher than the volume traded here. Obviously, this on the weekly time frame looks like it blasted through it, but then if you zoom in, and you can see, for example, when we zoom in on the 1 hour time frame, that initially this weekly had a nice rejection after a first touch. Of course, does not mean that just because we have a high volume node, this has to hold. As you can see, in fact, this had a little rejection at first, but then eventually we flipped it and backtested it for higher. So just because you have the high volume node, does not mean that 100% it will not hold, because if we have a lot of demand like we did here, as you can clearly see this big pump, these levels can easily be broken, even if we have a lot of volume traded there. But yeah, you should definitely use this because it can help you get a general idea of how strong that level could be. And then the last indicator that I will introduce, and by the way, all these things, they're about volume, so they will be looked into much deeper when we introduce order flow. And then as the last one, I will introduce open interest, also called OI. So why is open interest important? This is mainly important on the higher time frame, and it is mostly important when you are trading the macro trend. So for example, here, right, we have a higher time frame uptrend, and it can be used to identify how healthy this uptrend is. I mean, of course, you can even use it on the 30 minutes and lower time frames, but for that stuff, we will cover it with order flow. So I'm going to make like a little table here to explain it better. So we have the first scenario where price is going up, volume is increasing, and open interest is increasing. And to be honest, I don't know how accurate it is on TradingView because I don't typically use TradingView for open interest. I use ExoCharts or ATAS. But anyways, when you have this signifies that you have a very strong uptrend. So it is very bullish. I'm going to show you on ExoChart because it is much better. Let's take this uptrend that we have right here. So as you can see, in this move right here, we have high volume, 25 million every 30-minute candle. You can see the 30 minutes right here. So the volume is 17 million, 18 million, 50 million, which if you go and compare to the average volume that we have in the previous and the next candles, you can see that 50 million, 20 million, once again, basically 20 million, 25 million, these are much higher than, for example, the volume that we had here at 3 million, 2 million, 7 million. And also ExoCharts tells us directly by putting them in green when you have higher volume than usual. And then you can see that open interest is increasing. And then we have price increasing as well. So we classify this uptrend as a healthy uptrend, as a strong uptrend. So as I was explaining here, when you have these conditions, that's when you have a strong uptrend and it is very bullish. Then let's cover when we have a weak uptrend. So a weak uptrend, you typically have price going up, of course, the volume is decreasing, and the open interest is also decreasing. And this means that we have a weak uptrend, which is bearish. So open interest is basically how much money we have in the market. So if open interest is going up, that means that we have new money entering the market. And when open interest is going down, it means that we have money leaving the market. So what is money entering the market? You have money entering the market when you have new longs or, for example, new shorts, because that is fresh positions opening, new positions. Whereas you have OI decreasing when you have, for example, shorts covering, which means that there is people buying their position back in order to get out of the position, right? So that's money leaving the market because you had your short position, you close it with a buy order, and that money is now leaving the market. And the same thing, of course, it is when you are closing your longs. So for example, if you are getting liquidated or if you're taking profit on your long, you are taking money out of the market, and therefore the OI is going to be down. And that will be shown with open interest going down and shorts increasing. However, that doesn't mean that people are shorting. That means that the buys are now taking profit or getting liquidated. So we can use this to understand how healthy the move on an asset is. So the weak uptrend typically happens when we have shorts getting squeezed. Squeezed means that they are covering. So when you have a lot of shorts and a loss, they will start buying back their position, which will bring price up. Volume is decreasing. And the reason why the open interest is decreasing is because, remember, these are not new longs opening. That's not people getting bullish. It's not people getting bullish and saying, okay, I want to buy at this price, I'm entering my new position. No, it is the shorts that are covering their position because they're in a loss and they're closing with a buy order. And therefore, it is signaling that the uptrend is weak and it is only fueled by a short squeeze. And therefore, it is bearish. And that's when, for example, when we start reaching our point of resistance, we can be like, okay, that's not really a strong uptrend. We have quite a weak uptrend that's bearish. And now we have another confluence for our short to possibly work out in our favor, for example. So we can put this in green because that means that it is a strong uptrend. Then we can put this one in red as it is bearish. So let me give you an example of a weak uptrend. For example, I can already see one here. For example, we have here price going up, open interest going down. And if we go and look at the volume, there is some parts of higher volume, but mainly, look at this, we have 3 million, 7 million, 3 million, 3.2 million. Sure, here we have 25 million, but I can clearly see that it is caused by longs taking profit. And that's because you have very negative delta, minus 20 million. You can clearly see there's a lot of shorts opening with declining open interest, which means that people are closing their long positions. So these are not new longs that are opening. So that's just people taking profit. And once again, we never really have crazy volume. As you can see, even here, we continue our uptrend. OI is still down, very low volume, nothing crazy, 10 million, 12, 5, 3. Eventually, we do start getting a lot of volume here, but that's still a short squeeze. So, nothing of what we could classify as a strong uptrend. And as you can see, this whole move was actually fueled by the whole open interest going down. That doesn't mean that it has to reverse. It just means that it's not a healthy uptrend. Then we have price going down. Volume is increasing. And open interest is increasing. This is when you have a strong downtrend, which means that it is very bearish. We can actually see this quite a lot on the graphs and especially on the most recent pullback that we've had on Bitcoin. So look at this. So we have open interest clearly going up. The volume is getting big, 40 million, 83 million, 80 million, 50 million, 36 million, 23 million, 76 million again, and 59 million. We can clearly see that these are new short positions. Look at all these shorts. Look at all these red boxes that we have right here. So this shows a very strong downtrend. Therefore, if, for example, we have a support level at 122, right? And this is what typically helps you save a lot of money. If we had that support at 122 and we open the order flow and this is what we're seeing, we're not going to even trade that level for a long trade because we know that at the moment we're in a very strong bearish downtrend. And perhaps we can start looking for exhaustion eventually. Like for example, here, as you can see, the aggressive selling stopped. And that's when you can start considering for a potential reversal, which kind of happened. We had a little bit of a bounce eventually. And then it starts once again. Open interest increasing, price going down. Let's look at the volume. Very high volume. Eventually I'll teach you about delta. That also really helps. So yeah, this will help you understand how strong the trend is and to avoid taking stupid trades. And then we have the last scenario where price is going down, volume is decreasing, and open interest is also decreasing. And this typically happens when longs get liquidated. So you don't have aggressive shorts entering the market. There are shorts, but it's just simply the longs closing their position. And this signals a weak downtrend. And therefore, it's a little bit more bullish. And we have a higher likelihood of expecting a reversal. Okay, so I hope that all of this is clear. You can take a screenshot, and this will be, once again, really helpful once we cover order flow once again. So yeah, that's it for today. Not a lot of stuff, but quite important. And in the next lesson, we will be looking at volume. So tools such as the very powerful Anchor VWAP, the fixed volume range, and other cool stuff. So I will see you in the next lecture.